Now, for the first time as shareholders, we are also getting to experience our efforts in the field of artificial intelligence live. This is the first time you are directly affected by our internal progress, so to speak. As you know, for almost 10 years now, we have been implementing algorithms based on AI in our products. And now, for the past 2 years, we have been systematically optimizing our internal business processes through the use of AI. What you will experience here in the German call is that you will see English slides, while the English colleagues later will see the original English slides, but with a translation of my speech into English. And now I have to make a special effort to speak very clearly and distinctly, so that the AI can then translate my speech perfectly into English. We welcome feedback and look forward to the further development of AI, not just here, but also in the optimization of our business processes at Hypoport and the resulting innovations and cost efficiencies that we are able to achieve. That brings us to Hypoport's figures for the first half of the year. I'm pleased to be able to present you with strong figures, driven by a private real estate financing market in Germany, which has now been moving in a positive upward trend again for 6 quarters. This has resulted in double-digit growth figures in our main segment, real estate and mortgages, and of course, it has also given a boost to all our key figures for the group as a whole. Beyond that, I would still mention the ERP platform for the housing industry as another highlight, which is developing excellently with tremendous support from the sector and rapid high double-digit growth in the number of user units that have already migrated to the platform or are in the process of being onboard after contract signing and are currently in the project phase. Lowlight. At the moment, I would say, looking beyond the private real estate financing market, we are still facing a recessionary overall environment, which is also affecting the platform, especially the platform segment financing platform in its respective submarkets, quite significantly. Here we are all waiting together for the right decisions to be made by our new federal government, which unfortunately is still taking its time, and after the revised recession figures from the last quarters, really has no time left. In the area of insurance platform, even though it is not an explicit lowlight, we are waiting for the successful development in the market to also be reflected in the figures. Here too, let's say, a rather subdued first quarter. And certainly, as a lowlight, it still has to be mentioned that, in the area of the group's valuation solutions, although we are making very rapid progress in terms of content and are also reducing losses, we are still slightly loss-making, but nevertheless on track and hopefully soon to be on the good news side. So, when we look at the segments, let's start with our core market, real estate and mortgage, and of course, the private property financing market and our activities centered around private property financing. There isn't much new to report here at the half-year mark. Basically, we are following a positive macro trend here. Families are still looking for home ownership. The existing property market, that is, the purchase of existing single-family homes and owner-occupied flats, has continued to move positively upwards in recent months. We are clearly benefiting here from a trend away from renting by small landlords in Germany towards direct purchase by families, because renting as a business model has, politically speaking, been treated negatively for, you could say, a decade now, and is now often no longer profitable for small landlords. On the other hand, young families, as in the past, have a strong desire to shape their own four walls, which is much easier to do with home ownership than with what is currently still available on the rental market. This whole situation is also, and unfortunately one has to call it a macro trend by now, accompanied by low levels of construction activity. So, even though there is high demand, there is comparatively little construction activity, with the number of completed buildings continuing to show a strong downward trend. This is now also leading to slightly rising prices again. This does not have a dampening effect on the market yet, but rather a positive one. It is known that if you invest in residential property today, this value will be preserved or even develop slightly positively above the rate of inflation. So, it increases the confidence of potential buyers in acquiring residential property. From the federal government, There was in fact no direct positive impact on the market in the first half of the year. You could certainly say that the significant extension of the current rent cap until the very end of 2029 is a remarkably clear and undeniable signal to all small landlords that their fundamental interests in diligently preserving their capital and investments are absolutely no longer being adequately taken into serious consideration within the realm of contemporary politics. This decision will continue to support the move away from the rental market towards a home ownership market in Germany. Beyond that, and this is really just a collateral effect from the perspective of policymakers, there have been no activities from the federal government in this area. Still, the overall conditions for the market look positive, and that's why both the market and Hypoport are developing very positively in this segment. We have a fairly stable sideways trend in interest rate developments. It was a bit more volatile in the first half of this year than it was last year. We saw an interest rate shock, a minor interest rate shock in March, due to the federal government's new debt programs, that then subsided again, and yet it still led to, so to speak, slight shifts within the first half of the year, with people arranging financing a bit more quickly and in greater amounts in March than in April. But otherwise, I would say, it's a sideways movement in our market in terms of the interest rate conditions. As we can all see together, inflation across the entire Eurozone and also in Germany continues to trend downwards, and the ECB's 2% threshold has in the meantime been reached on the downside. I would say that concerns about a structural rise in interest rates in the near future have also dissipated. We will probably continue to move sideways at the current level. This year, plus or minus 0.5%. Nothing that will significantly move this market. At the same time, we have many offers on the market. To be fair, you also have to differentiate a bit regionally. We can see that prices in the metropolitan regions are already rising significantly again. In Berlin, in the meantime, we are above the peak price level of 2022. But there has also already been a clear recovery in other metropolitan areas, even if they are not yet back at the 2022 level. And here, too, the number of properties on offer is already gradually declining again. That means the search processes for prospective buyers are already taking a bit longer again, while in the more rural states and in the regions further away from the urban centers there is an oversupply and the price normalization is still taking considerably longer. So, in this respect, it's a somewhat more fragmented market, and the higher number of properties mainly comes from the rural regions. In the metropolitan regions, the number of properties for sale is already slowly becoming scarcer again, with the corresponding effects on prices. You can also see that very clearly at the top left. We are seeing a structural upward trend in the apartment sector. In the case of detached houses, the trend was noticeably weaker, as they are, of course, mainly found in more rural areas. In this respect, it's not a move away from detached houses, but rather a confirmation of the trend that metropolitan regions are benefiting disproportionately from demand, even though prices are already high here and the rental markets are much more strained than is the case in the wider regions. Exactly, rental markets. Here, there is now a slight upward trend in the supply of rental flats, but at an extremely low level. However, it must always be pointed out that this is, so to speak, only the official market that can be observed, at prices equivalent to those for home ownership. That means everything that is widely offered here is being offered at rental prices for which, at times, you could also buy your own home. As a result, the German middle class, especially young families who are planning for the long term, are increasingly tending towards home ownership. How is Europace faring in this environment? Or perhaps let's first take a look at the market. Here we can see a gradual recovery of the German mortgage market, which is shown in the meantime both by a black line for the Bundesbank data and a grey line for the Schufa data. You can see slight differences here, and our understanding of the market continues to mature as we analyze this data further. The Europace platform operates in a large submarket of this overall market, namely the financing of private consumers who really want to create home ownership for themselves or who want to build, purchase, or refinance property. In this market, we see that in the trend development of the unintelligible, we see that, of course, we show a certain correlation with the market, that up until early 2022 we strongly outperformed and benefited disproportionately from gains in market share. But then during the crisis period, I would say, we also lost market share because there were drastic shifts within the market, also in its structure, so that our submarket was disproportionately affected by what happened. Whereas now, in the last 2 years, you could certainly say there is a certain noticeable correlation to be clearly seen, which in actual reality, if you meticulously break it down, is fundamentally based on many numerous smaller developments that have either positively or negatively contributed significantly to our outperformance of the broader market. Break time equals 0.5s/. The most important thing to mention here is that one of our major partners has, during this period, been structurally withdrawing more and more from the mortgage market, and we had to more than compensate for this decline in volume by gaining market share in other parts of the market, which we managed to do well. Structurally, we see that never before has more mortgage business in the market we address been processed through us than right now, and that both the breadth of the sales structure and the depth of the structure continue to increase everywhere. A look at the details of the 4 subsegments, which we would particularly like to highlight, also makes this clear. So, Europace is growing in line with the overall market. Dr. Klein Private Customers is achieving the same. Finmaz is showing a similar development here, despite structural gains, but surprisingly with a low-key figure. Here you can see that the savings banks are also doing a lot of business outside our core segment, which is at least included in the Bundesbank reporting, and Genopace is showing an outperformance. Even though the cooperative banks have a wide range of business activities, including those beyond what we would normally consider as private property financing business. If you look at the 3, it becomes clear that there is also something that is losing out. For us, that's the segment of private banks, which are underperforming, and that's primarily due to one major partner. So, structurally, we are gaining market share. This is best seen from the perspective of the intended uses. In the first half of the year, we are once again moving towards an all-time high in volume. That is, for the purchase of residential property. This is the core market we're talking about. And if you still remember the charts from earlier about the overall market development, the overall market is still quite far from reaching this volume. So, here you can best recognize the structural gains in market share. In the area of new builds, we are still seeing a marked reluctance at the moment, even though there has been a positive development here in the last 2 quarters compared to the previous year. This too is structurally our core market, which we're talking about historically. As you can see, it had a different significance than it does today. Everyone is affected by this structural effect. We do not expect any highly dynamic change here. Here, it's about structurally changing the political framework conditions. If we want to return to the new build figures of 2020 and 2021, we will benefit from this market in the same way and will be able to continue to make use of the market share gains we have achieved structurally. After that, we are in the refinancing market, where, due to our high share of independent broker structures, we have historically been disproportionately present and, from our point of view, are still disproportionately present today. We assume that there is currently a low volume in the market that is being refinanced, due to the interest rate kink and, so to speak, the options available in the 15-year fixed interest rate agreements. Nevertheless, it must be said that this is currently difficult to understand, especially when we look at the overall market figures and consider how this development can be reconciled with this topic, which is, in terms of content, actually quite good. And last but not least, the energy-efficient modernization. Something that has historically only had a small market share has, despite the political will over the last, you could say, 5 to 10 years, not significantly changed in terms of its importance for our market. And that's also something we can observe politically, something with huge potential for the future, because we have enormous challenges when it comes to refinancing energy efficiency measures in Germany, and yet it's still something that hardly shows up in our figures. Structurally, there's also the perspective of market change from the side of sales structures. Here, over more than a decade, we have slightly expanded our position in the area of brokers and independent financial distributors. Together with us, or even established by us, independent financial distributors have significantly increased their market share, and in this respect, this was and still is the core segment on the Europace platform when it comes to the question of where the volume originates. At the same time, over the past 10 years, but also in the last 6 months, we have been very successful in gaining significant market share in both regional banking groups, the Volks- und Raiffeisenbanken, as well as the Sparkassen. And here, to be a trendsetter, an innovator for modern mortgage financing, and, together with central group institutions, to successfully digitalize both sectors. There is an excellent trend here, which continued in the second quarter and, looking ahead, will persist for many more quarters. In the area of private banks, we already had higher market shares. The decline in our market share here is due to the structural change in private banks' interest in this market. European banking regulation certainly also plays a role here. But it is also a question of setting priorities within the individual institutions, especially regarding how equity capital should be refinanced and remunerated. And in this respect, the private real estate financing market is an area where you need a great deal of patience to be truly successful. Foreign banking groups, in particular, repeatedly demonstrate that this is possible. So, aside from looking at the market and the sales channels, let's also take a look at what I would call the segment's historical problem child. In property valuation, we've tackled a major issue for ourselves in order to shape the business process of private property financing more effectively in the interests of all market participants. We have now been investing intensively here for more than 8 years, and thanks to the restructuring measures of the past 2 years, we have been able to systematically work our way out of the heavy losses that arose during this market entry in the first half of the year. We are on an excellent path here, as we continue to invest heavily in the digitalization of business processes, in line with private property financing. The integrated offering from Europace and Valuations by Value AG is getting better and better, and is reaching more and more sales partners and banking partners out there. We are also currently rolling out the next major step in automated valuation processes within the cooperative financial network, and that is a huge success. So, looking ahead, the losses will decrease, and we will see a turnaround at some point in the coming quarters. That is very pleasing, and this is a long-term investment that will only really pay off for Hypoport in the long run. I am pleased with the recent developments here and wish my colleagues continued success in implementing our strategy. Overall, this means double-digit growth rates for the real estate and mortgage segment, with the seasonality we have seen this year. We had a very strong first quarter, positively influenced by the interest rate shock caused by the federal government, and a somewhat weaker second quarter, especially at the beginning. That is something that can always happen from time to time. That's nothing unusual for a market. In this respect, a slight interest rate sensitivity on a weekly and monthly basis is also present among consumers. Structurally, we continue to benefit here from the normalization and recovery of the market, and we also expect further growth from the market side in the coming quarters and years. This then builds on the broad market share gains we have achieved in the meantime and the cost optimizations we have implemented, leading to a structural improvement in our earning power, which is why we can also report a strong first half of the year. So, things aren't going quite as successfully from here on. We've now arrived at the housing industry. This is where the rental market, the social rental market, is at home, and as I already made clear in my explanations about the market environment for private property financing, it is difficult to operate here. We can clearly see this in the willingness of the housing industry to invest. The construction of new social housing has reached a historically low level, despite increasing subsidies from the federal government. But the complexity in the construction of rental housing has simply increased disproportionately, making it ever more expensive to build social housing, with corresponding consequences for the activity of the housing industry. Nevertheless, we were able to increase our volume lead. We assume that we are structurally gaining market share here, especially in this sector with which we are increasingly networking. With regard to rental guarantees and our platform for managing rental guarantees, there continues to be a structurally positive upward trend. We are gaining more banks that are working with us here and rolling this out in the housing industry. This is a successful long-term trend that ultimately benefits from rising rents, because this also increases rental guarantees. The greatest success in the segment, despite the challenging conditions, is the ERP system. In the meantime, 570,000 residential units are under contract. We can't migrate as much as there is demand for. That means we have a significant pipeline for migration to our SaaS platform and, well, we have to carefully scale the project capacities, so to speak, in order to respond to this enormous demand pressure. This also means that our investments remain high here, because the main work lies in the development and further development of the platform and in the migration. In the support of the digitalized portfolio, the profitability lies there, and as the portfolio grows, this will of course become increasingly significant. We are still running at a deficit here. We are investing significantly more than we are generating in revenue from the current, already migrated volumes. However, the momentum shortens the time to that point and increases the speed of the positive development of this business model in terms of profitability. So, a huge success for Hypoport and for the colleagues at Dr. Kleinau Digital there. Congratulations. We would be pleased if things would also pick up more quickly in the second subsegment of the German SME sector, that is, the corporate finance area closely linked to the use of government subsidies for German SMEs. We see the industry's need, but this has already grown strongly over several quarters, even under the previous government. We see our project volume increasing, and we also see the volume of completed projects rising, but with extremely low proportions of subsidies in the meantime. And our financing is dependent on the successful completion of the projects and is tied to the monetized subsidies. And as a result, our revenue is currently low due to the rather unattractive subsidy program, which still stems from the time of the previous government. Here, we are waiting for new policy directions, and in the meantime, we are continuously expanding our sales activities. Within the German SME sector, we are launching consulting projects and, together with our medium-sized clients, are expecting that the new government will deliver in the second half of the year or, at the latest, next year. The last subsegment, installment loans. For the first time in a long while, we have to report a slight decline in transaction volume for the first half of the year. Fundamentally, the market conditions here are also challenging in a recession. Banks are more cautious about approving installment loan business in a recessionary environment. We are also seeing that default rates are currently rising significantly at many banks, and in this respect, this caution is of course justified. From a macroeconomic perspective, it is naturally a problem when less credit business is taken up by consumers. This reinforces the trend towards consumer restraint during a recession, which in turn feeds back into economic activity. We are making our contribution by making the available installment loan offerings widely accessible at banks, introducing the Valve solution to more and more primary banks, especially within the cooperative sector, and we are also in talks with many institutions from the private banking sector as well as with savings banks, because they have realized that the installment loan business is particularly challenging in a recessionary environment, and that specialists can offer solutions via the platform. Therefore, there is a positive outlook for this subsegment, even though, for the first time, we have to report a slight decline here. That brings us to the overall figures for the segment. Here, things are not moving upwards with the same momentum as in the real estate financing segment. Here, we are seeing single-digit growth rates. We assume that our structural successes will, once the general conditions normalize and we see a slight return to growth rates of +1 to +2% in Germany, also be reflected in double-digit growth figures. EBIT is slightly under pressure for the first half of the year. This is due to the investment activity that we are undertaking broadly in this segment as well, As I mentioned, we continue to invest heavily in the ERP platform for the housing industry. At the same time, the installment loan segment is also a key focus for us, because we see structurally that we can achieve a sustained outperformance of the market here. That brings us to our final segment, insurance platform, with its three subsegments: private insurance, occupational pension schemes, and industrial insurance. Here, we are seeing many exciting business opportunities emerging in all three subsegments, but unfortunately, monetization is still delayed, so this is not yet clearly reflected in our key figures. So, in the area of private insurance, our KPIs are the volumes of migrated portfolios we have on the platform, which continue to grow slowly, this time, for once, not even in double digits in the first half of the year, despite positive developments. We are also continuing to see positive developments in the portfolio that we have validated together with the insurance industry on the other side. In other words, the proportion where we have enabled the platform as a data platform in both directions, making valuable services usable in the first place. And yet, the process remains slow. In our view, the discussions and the needs of the industry are becoming more intense and more serious. A similar development can be seen with Carify. We have just announced the signing of another major industrial broker here. These are all still tough initiation processes, and we are still in the launch phase, which we had actually expected to be shorter. However, the positive feedback from customers also reassures us that the enormous investments we are making here will continue to pay off in the long term. Last but not least, ePension, our platform for occupational pension provision, still showing double-digit growth. At the moment, the market is suffering from a lot of uncertainty, especially in sectors affected by geopolitical conditions, where companies are less willing to invest in occupational pensions. There are also sectors that are booming here, but unfortunately our platform does not yet play such a major role in those. We are still very much focused on industry there. But our platform is spreading within the sector, and there are also many positive discussions, so we are optimistic about the future, even for this subsegment. All in all, I would say it was a weak first half of the year for insurance, for the insurance segment, if we look at the monetary figures. No growth, and that's something we want, something we expect. We assume that the second half of the year will go significantly better, that we will clearly end up back in profitability, and that we won't just maintain this small negative figure that we had to report for the half-year results over the rest of the year. So, we are expecting a positive business performance for the whole year, and this is also fueled by the many leads generated in the first half of the year, which will also be monetized in the second half. With that, let's take a look at the group's overall key figures, which are, of course, correspondingly affected by the performance of the three segments. Strongly driven by the successes of the real estate and mortgage segment, we've seen double-digit growth rates in all key figures here, and due to the base effect, a disproportionately high increase in our EBIT as well. All of this is in line with our expectations. So, after a very positive first quarter, as mentioned, particularly triggered by the interest rate impulse, we've now had a normal second quarter and we're looking to the future with optimism. To put it all in context again, from a long-term perspective, we are now at about the same level of earnings power as the total annual value of the previous year. Here you can see the scalability of our business models. You can also see the cost efficiency, which we continue to maintain at a high level within the group, because our goal remains to deliver record results across all key figures next year. As far as it looks, in terms of gross profit, we're already in line with a record annual result and will, it seems, definitely outperform the previous record year of 2021 this year. So, in that respect, the long-term trend continues. We're experiencing qualitative growth during a period with a diverse market environment. That's how I would put it. It's important to us that we gain structural market share, that we strengthen and expand our market position in all markets, so that when the conditions inevitably normalize, we can benefit disproportionately. After all, if we perform very well, our competitors will ultimately come under even more pressure than we do. So, with that, let's take a somewhat more detailed look at the outlook, if you will. Let's focus in particular on our core market, private property financing. In retrospect, it's very pleasing that our expectation that the interest rate shock would occupy us for between 4 and 8 quarters turned out to be correct. The trend, if you will, has reversed after 6 quarters. We've now been in an upward trend for 6 quarters. You can clearly see that it's not rising as quickly as it fell. I think that's fairly normal with such large macroeconomic processes. But we're on track towards the old trend channel from which we came. The main reason why this trend will continue is the shift out of the rental market and into the home ownership market in Germany, which has now been taking place structurally for several quarters. And, the whole thing will be supplemented, and the speed at which it happens will also be influenced by the conditions in new construction and, from 2027 onwards, by the resumption of refinancing. And as the icing on the cake, if we ever get serious about energy-efficient modernization in existing buildings and the heating transition that we all want, then on the way to, at the latest by 2050, when neutrality will also be enshrined in EU law, we will have to invest a great deal more money. That's a kicker upwards and, so that at some point this will be effectively tapped as investment potential, we see a high level of dynamism in the normalization and recovery of the market, and ultimately we see this market reaching 100 billion per quarter. From this, the next few years will also benefit Hypoport in particular, and we will be able to confirm our structurally double-digit growth rates not only through gains in market share, but also directly from the market itself. For this year, we can say that our expectation is that we will achieve strong growth in EBIT and, or strong growth in revenue and gross profit, and in addition, that we will almost double our EBIT compared to last year. This expectation remains unchanged. We are in line with our expectations there and, we are looking positively towards the second half of the year,